Good evening. Greetings from wherever you're joining us from. We shall be taking a deep dive into the conversation on the revised overhaul of the risk-based credit pricing model in the banking sector. My name is Julian Samboko. I'm affiliated to the Nation Media Group, where I consult on matters editorial focusing on finance, business, and economics. Our keynote speaker is a man who heads up research at the Kenya Bankers Association, and that is Dr. Tiriongo. I'll give you an opportunity to introduce himself. But before that, allow me to do some scene setting. Interest rates, or the cost of credit, is always an emotive issue in Kenya and in any other country. In our case in particular, we've had some significant evolution, which goes back to the mid-90s when interest rates were liberalized, but that's too far back. Let's come a little closer. Sometime around the early 2010s, there was a conversation around the fact that interest rates were not reflecting adjustments that were being made by the Central Bank of Kenya. And therefore, there emerged this component called the Kenya Bankers Reference Rate. This was under the leadership of Dr. Patrick Njoroge as the governor of the Central Bank of Kenya. And this was designed to ensure that as the central bank signaled the market, where it meets every 2 months and it either slashes or retains or hikes what we call its benchmark rate, which is a policy rate, then banks can adjust accordingly based on how the Kenya Bank's reference rate is moving. Now, that was pegged on the yield of the 91-day Treasury bill. This was in place between about 2014 up till about 2016, and there was so much agitation in this country, and one parliamentarian introduced a motion in Parliament to cap lending rates, and it sailed through the House. The whole argument was that credit was too expensive. Kenyans were being exploited. We needed to place a ceiling on how much banks could charge. It misfired significantly because whereas it was thought it would boost credit flow into the economy, it did not. And for the 3 years that it was in place, that is between 2016 and 2019, if you go and look at the statistics, there was severe contraction or squeezing of credit into the private sector. And that is what necessitated the discussion around a reversion to risk-based credit pricing models. And that took effect when the cap on lending rates were repealed in 2019 November. We then switched back to risk-based pricing. But here was the thing. Every bank had its own base rate. Every bank had its own baseline from which it priced loans. And that again, whereas it was designed to free up credit into the market, brought a bit of complication because, again, as we saw last year, which is 2024, whereas the central bank was rapidly cutting its benchmark rate, which is basically signaling the market on where interest rates should be, we didn't see a commensurate adjustment coming from the banks. And one of the headaches which was identified by studies was that because we don't have a common reference rate, one, comparability in pricing across the industry becomes a problem because the model you are using is not the one I am using, and we don't have a common baseline from which we are working. That is what has landed us to where we are, because starting sometime late last year through early this year, there was a heated conversation between the Central Bank of Kenya and banks as to the way forward. And here we are. The central bank published a discussion paper. It invited comments from the public. We all made submissions. And now we are at the juncture where we have a decision which has been taken and guidelines given around the way forward. So what is the way forward? We will be using the interbank rate. And we'll be making sense of all these things in this conversation, but I'm just setting the scene. We'll be using it as the common reference rate to help us on how to price credit. But let me not steal the thunder. We have an eminent guest with us, Dr. Samuel Tiriongo. Doc, please introduce yourself, tell us with which institution you work, and a little background about your professional life.
Thank you. Thank you, Julian, for the invitation to speak in this space. My name is Samuel Tiriongo, the Director of Research at Kenya Bankers Association. You may be aware that Kenya Bankers Association is an umbrella body of all banks licensed by the central bank, and we exist to champion for a conducive business environment for banks, but also the adoption of global best practices in banking. I'm privileged to be your speaker today and so honored. Thank you.
I should add that Dr. Tiriongo is an ex-central banker because he was with the central bank for quite a while. Doc, let's start from here. Why are we having this conversation? And for those who might not be familiar, what is risk-based pricing Why are we talking about an overhaul? Why was it necessitated? What essentially got to this point?
Thank you. Risk-based pricing is basically just attaching a specific price to a particular risk. So it essentially means that each customer would have to face a particular price that is associated with a particular risk. And that risk is their own risk as assessed from data that is availed. The reason why we find ourselves where we are, as you gave in your introductory remarks, you mentioned about the journey that we have taken as a country from a controlled environment in the 90s to the early 2010s when we moved into the KBRR. And by 2016, we moved to the interest rate capping period and the repeal that came in 2019. And then after that, we went into a risk-based pricing environment. But at the time, each bank was to define its own base rate. So the base rate, you would want to take it like, for instance, it is the risk-free rate or the rate at which a customer with zero risk would be able to access funding in form of loans from commercial banks. Ideally, with the transition to that risk-based pricing environment, which started off from 2020 and running up to the framework that is running now as we transition to the new framework, is that as banks developed their own models, of course, they looked at different parameters in defining their base rate. And then, of course, added the premiums as defined within their own internal processes. So it became very difficult for one to compare from one bank to another because the base rates are different. There are banks whose base rates are 12, others are 13, others are 14. Again, because of the differences in the components that go into the computation of the base rate. That would not be sustainable because global best practice again says that we needed a unified base rate that would then help customers be able to compare from one bank to another with a unified base rate. So what would only differ from one bank to another would really be the premium that is loaded on the base rate to form the lending rate. So that would become even much better in terms of the transparency that is needed in the pricing, because with a unified base rate is much clearer. It would be much easier for consumers to know what components really drive their lending rates at the end of the day. So as we transitioned, there is a stronger emphasis now on the premium K because there is a unified base rate that is benchmarked on the interbank market and is called KESONIA, which is the Kenya shilling overnight interbank average. So the whole objective with a unified base rate is that we were looking for a base rate that is tied or linked to the central bank rate. And that, of course, would help in ensuring that there is transmission of monetary policy directly to the lending rate, because if the benchmark is linked to the central bank rate, then, of course, there is a direct transmission from the policy rate to the market lending rate. So that was the premise behind the transition to a unified base rate.
Thank you, Doc, for your introductory thoughts, because you've said a lot. Allow me to unpack this in bits. When Doc talks about transmission, it is the whole idea that when the central bank signals the market by way of adjusting its policy rate, which it does once every 2 months, and it can decide to retain it where it was, by the way, then banks should commensurately transmit that, hence the transmission word there, to the end borrower, because remember, the whole idea is the flow of credit into the real economy. Now, Doc, allow me to stay there for a bit. Why is it that in 2024, whereas we saw the central bank aggressively cutting its policy rate, we didn't see a commensurate adjustment by the banks when it comes to the average lending rate in the market? Many have argued that 2024 is the year where banks flouted the social contract of banking. Doc.
Even before we discuss the 2024 happenings, allow me to even step back one more year. 2023, Central Bank announced there's a commitment now to an interbank corridor. And the interbank corridor was to ensure that there is transmission, or at least the adjustments in the central bank rate would actually be reflected in the interbank market. And that explains why our interest now is in the interbank market to become a reference rate. But remember that from 2023 all the way to the current period, the base rates that have been applicable in the market are not linked to the central bank rate. They were linked to the cost of funding in the banking sector. So ideally, the base rate was not responding to the central bank rate adjustments because of the fact that a majority of the base rates, which are actually benchmarked on the cost of funding, direct cost of funding in the market, would not necessarily respond to the central bank rate adjustments. And allow me then to just demonstrate using a cost of funding, because the cost of funds is really, you're looking at the cost of borrowed funds that banks have to extend at the end of the day, the cost of deposits. So before a bank is able to adjust its base rate that would be based on the cost of funding, then it would have to observe the adjustments in the deposit rates. It would have to observe adjustments in the cost of long-term funds that are used for extending loans. Ideally, the direct response of lending rates was linked to the adjustments, or at least the actual movement in the cost of funds that banks use for extending loans. So because that formed the basis, the base rate for lending, it became difficult. It became quite rigid in terms of being able to witness an adjustment commensurate to the adjustment in the central bank rate. And that, of course, even what triggered the move towards a unified base rate that is linked to the central bank rate, so that there is effective transmission, or at least to a great extent, we see a commensurate adjustment in the lending rate based on the adjustment in the central bank rate. So it's basically because the base rates were not tied to the central bank rate. And that continues, of course, even in the current period. But until we see the full implementation of the current framework is when we expect to see a stronger transmission of policy rate adjustments to the lending rate.
And in case you're lost, so when Doc talks about cost of funds, think about it this way. Banks work by taking deposits for those who have excess capital and lending them those who are looking for capital. When you take your deposits to the bank, you will demand an interest. And that is basically the cost of funds. And of course, the underlying principle is always that deposits are just as expensive as where you can deploy them. So because banks were taking deposits at high interest rates, remember last year we had high yields in the fixed income market, which is treasury bills and bonds, it became a challenge for them to extend the same at a cheaper rate to the end borrower. And that is what he's talking about, the cost of funds predicament that we had in the latter part of 2023 and the better part of 2024. So Doc, here we are. We now have guidelines from the Central Bank of Kenya telling us going forward, we shall use the interbank rate. And by the way, the interbank refers to the rate at which banks borrow from one another on short-term basis within the window in which they apply. How significantly different is this? And also help us understand, because we have seen a conversation around whether it is simple average being used of the interbank or compounded in arrears, which is actually what the central bank has said will be applicable. Please demystify this for us.
Okay. The interbank, as you put it, of course, the rate at which banks lend to each other. And the current reference is based on that rate that is applied on one-day loans that banks would extend to each other. So we treat that as a wholesale of funding. Of course, if you look at markets, you're considering wholesale and retail. So ideally, banks, the cost of money in the market is being reflected on the one-day lending from one bank to another. And as I mentioned, from July 2023, Central Bank announced a transition in how monetary policy would actually be implemented. And the transition would be that central bank, upon adjusting the central bank rate, would now endeavor to make sure that through injections and withdrawals of money from the economy, the central bank is in that business of ensuring that the amount of money in circulation is commensurate with other market factors, for instance, the performance of the economy. So ideally, whenever the central bank adjusts the central bank rate, assuming like it's reducing it, so the desire is to also reduce the interbank rate. And what would happen then, following a reduction in the central bank rate, the central bank would be keen then to ensure that there is additional supply of money in the economy to that extent that it pushes down the price of money, which is the interest rate. And that interest rate that is watched would be the interbank rate. So the central bank announced that commitment to ensure that it will endeavor by all means, whenever there is an adjustment on the central bank rate, to make sure that the outcomes or the interbank rate, whenever there is an adjustment on the central bank rate, the interbank rate would oscillate, would move closer to the central bank rate. And that is done through liquidity injections or withdrawals from the economy that would be done by the central bank. So now that the central bank announced that transition in the market to focus on the interbank, the interest of the market was also to look at interbank because it is now tied to the central bank rate. And because global best practices in setting benchmark rate are actually based on market-determined rates, our interest was to look at determining the unified base rate based on the interbank market. And the confidence that comes with that is because now the interbank market has been aligned to the central bank rate. So our choice of a unified base rate, even in consultation and in agreement with the central bank, was to follow the global best practice in which unified market base rates are actually benchmarked on market rates, and therefore our interbank, the choice of the interbank rate. So you mentioned about compounding as well as comparing it with simple averages. Ideally, of course, simple averages are easy to understand, but whatever you are averaging, you would be averaging backwards. Like for instance, you can only pick up rates from now going back into the days past. So that, to a great extent, would be backward looking. Assuming today the central bank was to adjust the rate further, you would be keen that the applicable rate going forward for pricing of loans would actually be a forward-looking rate, a rate that is current, so that you're looking at the cost of funding. The reference rate would be the central bank rate that is applicable at any given time applies going forward. So when they set the rate today, it would be applied going forward into the next 2 months. And therefore, the interest was to look at how best can we make sure that we have a more current rate as opposed to a backward-looking rate that would be carried in a simple average. And therefore, that's where the compounding in arrears came in. So when the interbank rate is announced as, say, 10 or 12% or 9.5%, that rate is annual, in as much as it applies for money that is extended today as a loan and repaid tomorrow. That rate is annual. So you can as well divide that by 365 days to get what would be earned per day. So ideally, the whole subject of compounding in arrears was to look at what can be earned on a particular loan on a per day basis, based on how the interbank is faring on a daily basis. So you're basically earning, for a loan that was extended yesterday, it is earned today. And what is extended today would be earned tomorrow, because the interbank market is operational every day. So there's a rate for every day. And therefore, what you would pay at the end of the month is really a accumulation of what you earned every day over the next 30 days. And therefore, that would be what you would pay cumulatively. So it's basically benchmarking the rates on the current cost of wholesale funding as determined by the interbank market, but at the same time also being able to communicate to customers that we are benchmarking our loans on the most current rates. So that's basically the difference in terms of the daily compounding as opposed to simple averaging.
Doc has said a lot, so let's try to unpack it in a manner which we can all relate to. He began by speaking about the Monetary Policy Committee meeting of July-August 2023, which was very consequential because it introduced the corridor designed to anchor interest rates. In simple terms, think about it this way. You have a road and you have guardrails on the side. The whole idea behind having the guardrails is to ensure that even if you swerve off the road, you don't veer off too much. And that is the whole idea behind the corridor. It is meant to anchor the interbank to play within where the benchmark rate of the central bank or the policy rate of the central bank applies. Why is that important? Because if the two track each other, you can easily use either as a common reference rate and you'll be finding the same transmission, or when the central bank adjusts, the interbank should equally adjust based on the changes made by the central bank. That's where he started. The second one was the question of compounding in arrears. And here is the easy dichotomy of simple average and compounding in arrears. So if you use a simple average, you'll be using a historical average, whereas the central bank's decision is to be forward-looking. And that is why if you read the guidelines from the central bank, there is actually a provision for a look-back period when it comes to the compounding in arrears. The whole idea is to ensure that whatever average you're using reflects the desires of the present time and is not a lag, which then presents a problem of delay in transmission. Good points there, Doc, and thank you for clarifying that for us. Another question is this. Many have asked, we have been in this position in the early 2010s when we tried KBRR and it was anchored on the 91-day. How significantly different is this? How sure are we will not end up with the same results that we had during the KBRR season?
So the computation of the KBRR was really just a simple average of the central bank rate and the 2-month 91-day T-bill. So the reason why, again, of course, to a great extent, that was backward looking because it's a simple average looking back. And then secondly was the fact that at the time in 2014 to 2016, there was no commitment like it exists now, like what we explained about the corridor. There was no corridor in terms of ensuring that the CBR, there's a transmission from policy rate to a market rate. So CBR existed, but then there's no strong transmission to affect market conditions as it is currently, where the CBR has actually been anchored to affect interbank market. Then secondly also is the fact that the 91 T-bill rate is basically a reflection of the borrowing conditions and the borrowing requirements by the government. So it's a fiscal policy rate and therefore may not necessarily from time to time affect monetary policy rates. So the fiscal policy in the sense that there are times when the government needs to borrow more. When the government needs to borrow more and there's increased appetite for money, the T-bill rates would go up. And that does not necessarily mean that lending rates for other loans to the private sector also need to go up, in as much as they may affect each other through the cost of funding. But ideally, the T-bill rate is just a reflection of the borrowing appetite of the government at any given time. So the two factors, the fact that it was backward looking, the other factor that there was no commitment like we have now for the corridor, and the fact that the T-bill rate is a fiscal policy rate meant that there was going to be weak transmission and a misalignment in the market. You would have a situation where, because the government is borrowing more, so rates are going up, and therefore that would trigger the need for lending rates also to go up. And yet maybe at the same time, the CBR is being adjusted downwards. So the transmission is mixed because the CBR and the T-bill rate could move in different directions. And therefore, there are mixed signals in the market that could not be transmitted to actual lending rates.
There's a question which I think we need to discuss. There's a widespread expectation, Doc, out here that once the new risk-based pricing model takes effect, interest rates should come down. I have argued against it and I've indicated that the only thing that will change is that you will have more visibility as a borrower. Transparency will be enhanced and you'll have more window for comparability across banks. Doc, now that you speak for the banks, what is the true position?
The true position is really would be, one is, I would want to say it depends on your risk profile. So assuming today you have a loan in a bank, the product is priced at say 15%. Now, as we move into the new framework, we have a unified base rate that maybe currently would be around 9.25 with some variations there. But then there's a premium that is loaded to your base rate. And one of the factors is really the costs that a bank incurs from lending business. And the other element is expected or the target return to shareholder. But there is also the risk premium of the consumer, the customer. Now, your risk premium is what would drive whether there is an increase in the premium K or not, because you expect the cost related to lending by a bank not to vary too much too soon. You also expect the expected return would be the target return for the year, essentially. You'd see that. So what would vary most in the year would really be also your own risk premium as a consumer. So the starting point would be, as we transition to this new framework, customers whose risk premiums push them to a category of high-risk customers would have to face higher rates. Customers whose risk premiums point them to low-risk customers would actually have the benefit of facing lower rates. So there would be a split. And of course, that split eventually would show how each customer's rate would actually move is highly dependent on your risk profile as a consumer. So we cannot say it is going to go up or down. It will move in tandem with your risk profile and actually depict and mirror completely your risk profile as a consumer. So there shouldn't be a general expectation that rates would move down or up. What we are only going to see is that there is going to be greater transparency. We are going to show much more detail in terms of how each customer's lending rate is computed. That, of course, is driven by their own risk profile.
Doc, now that you've touched on the issue of the risk premium, let's unbundle that formula. So, of course, there is the cost of operations of the bank, there is the shareholder return, and there is the K component. And many have asked, what assurance can we get from banks that when it comes to the K component, because the K is what relates to my personal risk premium, what assurance can we get from banks that there will be no mischief, if I could call it, around K to amplify margins?
So what's expected in this transition is that banks would prepare their risk-based pricing models. And as they prepare their risk-based pricing models, apart from indicating how they are going to measure the costs related to lending, and of course how they determine the return to shareholders, they would also be able to indicate how they're going to do scoring, risk scoring of each consumer. So there would be a risk scoring model that is formally approved by a bank, and its board, of course, would have to approve it formally, and that risk scoring model would also be shared with the central bank. And of course, whenever central bank then would be doing surveillance of banks, the central bank would be looking at how banks have adhered to the risk scoring model that was approved by their own board. So we do not expect that there is a switch in between of the risk scoring models and that customers would not face what is promised that they would face, because at the time of negotiating for a loan, ideally the customer would be given much more detail in terms of appreciating what drives their cost. They would know their risk score. And the reason behind this is really also for customers to be able to remedy. If their risk score is not good and therefore you're facing higher rates, then you can actually invest more in ensuring that your risk score is improved. And a customer would be able to link their risk score to the rates that they're actually facing at any given time. So whenever there's a change of their risk score, again, the bank would be able to disclose that, and the customer is notified that their risk score has changed, and the reasons behind that risk score are also made available to the customer. So, for instance, if a customer fails to pay a loan or the credit reference bureau score has actually deteriorated, then that triggers a bank to also adjust their rates accordingly, and the customer would be made available whenever there is a change on their risk scores. And that, of course, would be what is translated to the lending rates. So that's the governance mechanism that has been put forward. So all risk-based models by banks would be approved by their boards, and banks would be accountable to what has been approved.
We have seen in the guidelines given by the Central Bank of Kenya that in instances where the interbank is not applicable, banks will have the window to revert to the benchmark or the policy rate as their unified base rate. I'm very curious, in what circumstances do you envision this taking place as the association?
Because we are transitioning to a daily compounding, as I mentioned, definitely those rates are going to change from day to day. So it's expected that variations in how much you pay would actually be more on a monthly basis compared to if you were to adopt the central bank rate as your benchmark, because that means then it remains the same for the 2 months before the next meeting of the central bank rate. If they retain it, again, that remains more or less the same. So ideally for customers that are keen to see much more predictability on how much they pay and are able to compute it in advance, then the central bank rate becomes a readily available benchmark. So again, it depends on the conversations that a bank would have with the customers in terms of there's availability of the central bank rate. There is also the availability of the KESONIA as a benchmark. But at the end of the day, of course, there's a give and take if you look at it, while the central bank rate would remain fixed. So that means that whenever then the KESONIA would go below the central bank rate, because it would go, KESONIA is allowed to vary within 75 basis points, 0.75% above and below the central bank rate. So whenever it would be below, then that means that the customer may not see that benefit because they have fixed at the central bank rate. So it's a choice that the customer would have to make. Both are availed for the customer to make that choice. It's more like the choice between a fixed rate and variable rate. Do you want to benefit from rate adjustments downwards that would come with KESONIA going below the central bank rate in the 2 months? But the risk also of it going up is also the same. There would be give and take in the choice between central bank rate and KESONIA, but both are availed. But ideally, the choices are based on what the customer feels is actually works best for them. But the banks are encouraged to avail both to their customers.
My next question is this. You and I do know that the interbank market, as much as we are saying it is global best practice, is not without blemish. We have seen instances in this market where liquidity is either tight or skewed towards particular players, and therefore you see the interbank rate ticking upwards significantly fast. Granted, we now have a corridor which is meant to anchor it, but how do we ensure that then the new model does not leave borrowers vulnerable or exposed to this sort of anomalies, if I could call them, in the interbank market?
The interbank market definitely is a market like any other. It could have challenges, but the safeguards that have been put forward, and particularly with the central bank committing to the corridor and committing to the fact that now monetary policy would have to be implemented via the interbank market, in a sense sends the message that the central bank would also be keen to ensure that the interbank market is well functioning in terms of the number of trades that are there, in terms of volumes of trades that are there, knowing very well that the outcomes of that interbank market are actually forming the reference rates for all variable rate loans in the economy, so that there must be heavy investment in ensuring that the interbank market is actually well functioning. And again, one thing that the central bank did announce in this new transition is that there is going to be a risk-free rate. There is going to be a working group that continuously looks at the determination of this benchmark rate. And of course, the market from which the benchmark rate is drawn, which is actually the interbank market. So some governance structures and stronger emphasis in ensuring that the interbank market is working definitely are going to be put in place. And therefore, there is confidence that going forward, as we anchor all our lending on the interbank market, there is confidence that the central bank would invest more in ensuring that the market is well functioning and in delivering rates that reflect market conditions at any given time, so that we have full backing that what's coming out of the interbank can be fully relied, is credible, and therefore we can rely on them for pricing. And we also acknowledge, of course, there can be challenges. Even the application of, say, the sterling overnight rate in the UK, the SONIA in the UK, also faced a number of challenges right at the beginning in terms of its adoption, the readiness of the Bank of England to be able to make adjustments, as well as the advisory committee that is there to make adjustments as and when they come, definitely is something that we also learn from and are willing. And in fact, the reason why the central bank said we needed to have a working group that would continuously look at the functioning and the governance around this benchmark rate is well entrenched. So we have full confidence that we will steer safely through the transition period and even beyond.
Let's take some questions which are coming online here. Let me start with at Rego Math 100. He's asking a very interesting one here. Julian's bank's interest should be following the 10-year interest rate. It means the sovereign 10-year paper plus some premium. Most banks are around 13 to 14.5%, which is the 10-year plus this premium. The government should either reduce borrowing or make it such that everyone can invest in T-bonds via Dow CSD. Essentially, this guy is saying, whereas we are welcoming this new model, there's fiscal dominance, which remains a headache when it comes to credit pricing. Fair point or not, Doc?
It's a fair point. And the consideration that we are seeing now, of course, as I mentioned about the benchmark that we are relying on now, is really on one day money, which is overnight interbank rate. So the general understanding is that even as we determine the risk premiums, there is also a component of the term premium, which is now introducing the tenor premium, which is, in simple terms, is the time value of money for longer dated money. It must have a premium loaded on it as is structured. While we expect the publication later of 1 month, 3 months KESONIA, 6 months KESONIA, 1 year KESONIA, and even going forward into the future, in the meantime, as banks prepare their models, also looking at beyond the customer risk premium, there is also the term premium that is loaded based on the tenor for a particular loan, for a 5-year loan, for a 10-year loan, for a 15-year loan, for a 20-year loan. There would be a premium associated with the tenor of the facility. But on point, definitely, is that most of the funding now, based on the actual rates that are seen, it may be benchmarked on 5-year facility, on 3-year facility, on 8-year, 10-year facilities, based on the loan that we are seeing. But of course, again, loaded on that is the aspect of customers' own risk premium that is very critical.
So when Doc talks about the term premium and, of course, the time value of money, he's referring to the fact that if you look at money today versus money tomorrow, you anticipate that because of the fact of inflation and the erosion of value, you would rather have the money today than tomorrow. And that is why if you look at the sovereign yield curve, the longer tenor papers typically have a higher return than the shorter term papers because of that aspect of the term premium that he's talking about. And that is why many times when you have an inverted yield curve where the shorter term are giving you a higher return, then we say we have a problem in the market. Let's take another question here. At 4:10 p.m., Tiger Woods is asking, I know we touched on this earlier, but Doc, you can just revisit. Kindly explain the interbank market. Doc, over to you.
The interbank market functions as follows. So today, I write a check to Julian's, and Julian's banks the check with his own bank. So that means for all customers that banking with Julian's in their bank, the bank would require certain amount of money to make sure that the payments, particularly from the paying bank, would have to meet those obligations that are coming due. So when a bank assesses its liquidity positioning and there is a shortfall, it would go to the interbank market to borrow such an amount as to ensure that it meets its liquidity requirements on a daily basis. The interbank market is created for that, so that there is effective payments from one bank to another as they would happen, because customers are making payments from day to day. While there are inflows, there are also outflows. So the bank would make projections on their liquidity requirements and then go to the interbank market and borrow. A majority of the lending that happens in our interbank market overnight, so within just one day. So a bank would borrow today, and by 3 p.m. tomorrow, they've actually made the payments back. Bank can also roll over an interbank loan whenever it assesses that it still needs liquidity. But that is a market for funding from one bank to another. So that's essentially the interbank market. So the controls that have come in through that corridor that we see now, whenever a bank is lending to another, the pricing of that loan can only be within CBR plus minus 0.75%. So that the trades would have to be effected only within those bounds that have been stipulated. And the bounds were created to ensure that interbank market transactions reflect the monetary policy rate that has actually been determined by the Monetary Policy Committee. So whenever it goes, the central bank rate goes down, interbank also would have to go down because of that commitment that the central bank announced from 2023.
Let's take a very interesting question here, and this comes from Tita Cat. The guidance from CBK is KESONIA plus premium. Will some lenders offer KESONIA minus to big borrowers? Will this be allowed? And you can imagine where this person is coming from. Suppose my risk profile improves. Shouldn't it be KESONIA minus such that then the ultimate interest ticks downwards in this case?
Yes, it is true. Actually, the premium that is loaded on KESONIA to form the lending rate can either be positive or negative, in which case we're talking about a discount. But this would typically happen with corporate borrowers who have high negotiating power in terms of being able to, also they are mobilizing huge deposits. So they negotiate on the basis of the amount of deposits that they mobilize on the other end. So it's about supply and demand at the end. And of course, corporates, the large corporates have, of course, the prudent management of those large corporates would give them the ability. They are also audited. So there are a lot of information that you can use for assessing a corporate. Besides audited, they are also even credit rated. And because of that, there's a sense that their risk profile would really be very good to the point that they can negotiate for loans to be extended to them at below KESONIA. And therefore, their loans can actually be KESONIA minus a particular rate. Whenever a retail customer takes a loan and say, for instance, your risk profile puts you at KESONIA plus 3. Whenever your profile improves, then there is a gradual improvement from 3 and now you have KESONIA plus 2. So with demonstrated and consistent improvements in your risk profile, so the margins that are loaded on KESONIA would also continuously reduce. And that's essentially the most important factor in this new pricing environment, is that customers whose risk profile is good see the benefits of that through lower interest rates. Customers whose risk profiles are deteriorating also face a higher cost of lending. So it is really to encourage good behavior in our loan management to such extent as to deliver benefits through lower interest rates.
There's a very interesting question here from Maurice, and this has to be an equity investor because this question is speaking from a shareholder perspective. How is this going to affect future net interest margins?
So the margins are expected to also reflect a higher level of competition in the market, because now with a unified base rate, and banks would only be competing on the premium K, which is really going to be reinforced. The competition is going to be reinforced through the disclosures that would come on the premiums K, because we have a total cost of credit website where banks would be disclosing the premiums K that are loaded on the unified base rate. Of course, because the base rate is the same, the competition would really be on the premiums K. And because competition is going to increase, because margins are also expected to reflect a higher level of competition in the market. And that would also trigger banks to even be more innovative in terms of ensuring that they reduce their cost of doing business, their costs related to lending. For a bank to enjoy higher margins, then it must be able to ensure that there is continuously investing in efficiency and ensuring that their cost of doing business related to lending particularly continues to narrow from time to time. Adoption of best practices, adoption of technology, adoption of mechanisms and approaches that reduce their costs would be triggered for many banks because of the competition now that would come on the premiums. And of course, with increased competitions, the consumer is going to see higher benefits to them.
Let's take the question from Data Guru, who is asking, what happens to the unbanked masses? Will they have zero risk at start, or how is it going to be governed?
So it's expected that a bank would do both qualitative and qualitative analysis of the consumer's risk profile, because at the end of the day, quantitative, definitely the starting point would be the CRB data to know, and of course CRB would reflect your past loans. And some CRBs now have even included non-bank information. So if you're not banked and you've taken a facility elsewhere, that information would be availed in the CRB. But also even beyond that, banks have their own internal mechanisms of doing risk scoring. So you would now have to supply more information to a bank. And on the basis of that information, so you're profiled in terms of the risk profile and given then an appropriate, a commensurate rate that reflects your risk profile. There is always a starting point. If you've never been banked, then supply more information that would then help the bank to be able to do a proper and adequate and comprehensive risk scoring that would then give you an appropriate and commensurate rate.
So that the fact is that the information will be found to be able to determine your risk premium at that point. Let's take another question here where someone is asking, this is Rega Math, 100 is asking, what is going to have a larger impact? Is it credit guarantee or insurance? Or is it retail access to GOK bonds and T-bills like we're seeing with Dow CSD? Or is it number 3, risk-based pricing? And I would ask the Rega Math themselves, and why not combine the 3? Because it looks like that's what we are going. But Doc, let's hear from you.
I thought so too, that all actually are critically important because they serve different needs in the market. While we look at the credit guarantees, risk-sharing mechanisms, risk-based pricing is basically just fine-tuning to ensure that the assessment of risk is improved and there is transparency in pricing. As banks also make disclosures, you are able to make that judgment in a short span of time, because when you go to one website and you're able to see all the banks, the products that they have, how much they are charging within their portfolios, so you can gauge where you are at any given time and you make that decision at the end of the day. So if you're investing in bonds, the freedom to do is availed to you. So all of them are important for you as a consumer, but the important part is information availed to you that you can use to make a decision on what best to do as a consumer.
I don't see any other questions, and I want us to get to the tail end of this conversation. And this is where we discuss where we are and the timelines we are looking at. As we speak, we are in a transitory period between now and the 1st of December. So we're given about, I think, 3 months or 90 days thereabout. Between now and then, Doc, what are banks doing in readiness? And starting Deck Fast, what can we expect? And of course, Deck Fast is for all new variable loan rates.
Yes. So from 1st of September, the banks had 3 months. So the month of September, October, and November to prepare their models and get approvals from their respective boards. And of course, those models are speaking to the premiums K that would be loaded on the unified base rate. Now, as they prepare those models, discussions on alignment around how best to price and competitively price, particularly the premiums that are loaded, continuing now within each bank, so that they are able to create models that are able to best capture the risk profiles of consumers, are best able to capture the costs related to lending within each bank. So between now and the 30th of November, banks would be preparing the models and having them approved. From 1st of December, they would roll out all new loans based on the models that have been approved. And of course, aligned to this would be communications that also come to customers, because upon approval of these models, they would also begin now to transition the existing loans to the new framework, because even the existing loans would have to be transitioned to the new framework. So either central bank rate or the KESONIA. And that transition period begins as soon as banks have their models approved, and latest by end of February next year, all existing loans will have been moved to the new framework. So it's expected that customers will be notified of the changes that are coming, and of course aligned to the provisions, the regulations in terms of the notices that would have to be given to customers. Otherwise, I think the whole subject around preparation of models is critical. And that's why many banks are spending time just to make sure that even as they transition, they are also in compliance with the applicable laws and regulations that are in place, prudential guidelines, the laws on consumer protection, the laws around the Land Act that govern the securitization of land. So all that, banks would have to ensure that they are in compliance with all the regulations that are needed. The Banking Act also will have to ensure that there is compliance with the Banking Act. So that is the space that we are in. And of course, where, as guided by the central bank, where there would be implementation challenges, the central bank was keen to mention that there is readiness on their part to listen to any implementation challenges because it's the entire industry transitioning. And the desire is that we have a smooth transition from the current pricing to the new pricing that would deliver better transmission of policy, as well as also ensure that there is transparency in pricing that would actually be very instrumental in ensuring that customers are able to compare rates from one bank to another and make good decisions on their loans.
Doc, given your vantage view as an association, I'm sure you looking at the market, there must be some fast. As the central bank governor in last meeting we had to the MPC on October 7th told me that at least one bank has already submitted its new formula to the FX Bank. What are you seeing? What are some of the lessons you are drawing from what you're seeing so far?
So the lessons we are drawing from this is really on the need also for us to look straight into all the applicable laws that we have to. Of course, in the recent past, we've seen some suits on banks whenever there's a change of lending rate and things like that. And banks are being very cautious in the transition just to ensure that at the end of the day, we deliver something that is sustainable. We deliver models that would serve our customers best, no disruption in lending to customers, because it also requires, say, for instance, changes in offer letters, how offer letters for loans in banks are structured and drafted. So all that in terms of getting it right from the language part, getting it right with ensuring that the model is competitive enough is also very critical. Notices to customers, because this is a revolution in lending, so to say, particularly in determination of prices. And therefore, anything that is considerably large in terms of a structural change in how we do things would have to be taken in slow strides because of the caution that is needed. So as we go along, we've encouraged all our members that any implementation challenges, any challenges in preparing the models also need to be communicated so that banks are supported. So we're doing sensitizations on what is clear, and whatever is not clear, we're able to re-engage with the central bank and get clarity and feedback to the banks. The assurances that are needed, even as banks take the strides from one level to another, is something that we are investing a lot of time just to ensure that we don't leave any bank behind, because banks are serving critical customers that also need to be supported as we move forward. So definitely banks have, because of the different niche markets that they serve, can move at various speeds in terms of being able to prepare their models. So that recognition is important, that there are banks that would conclude these processes early, depending on the number of institutions, number of customers that you have, and the type of market that you serve. There would be those that have heavily sophisticated models, heavily complicated models because of the number of variables that have to be included in the model build-up. So that takes time. And there are also banks that may be affected by certain features of the model and others are not affected. So if you are affected and clarity is being gained from time to time, so that then becomes important, that the waiting time becomes very critical in the transition period. But definitely by 30th of November, the transition would be kicking off.
A very interesting question has come into my DM on X, and this person is asking, suppose I want nothing to do with KESONIA. Do I have the option of just telling my bank, migrate me to a fixed rate loan, and that becomes my standard operation? And I can imagine they're asking this because typically we have the perception, or maybe it is actually the fact, that the people who are best positioned to negotiate for this are the big corporates. I'm a retail borrower. I don't want KESONIA. Can I just tell my bank I want to be on the fixed rate, and that's the modus operandi going forward?
Yeah, of course, the assumption now is that the corporates would have a higher bargaining power. But what we are trying to do also is to create a bargaining power for even retail customers, so that if you can demonstrate that this is my risk score, you can demonstrate supplying adequate information, then you can kickstart a conversation with your lender, with your bank, that it deserves a better rate. That conversation is what we want to trigger by ensuring that prices are solely reflective of your risk profile, and therefore the consumer would be asking questions around, why am I being rated as such? Why not this? Have you considered this? Have you considered that? So that's the healthy conversation that we're trying to encourage. However, should a consumer feel that they need a fixed rate loan, that is readily available within a bank. And of course, then the conversations around the fixed rate in terms of where the fixed rate is would now be between the consumer and the bank, because fixed rate loans are not subjected to KESONIA and premium. Therefore, all these variable terms that come with KESONIA and the premium K. So that would still be availed to a consumer. KESONIA is only applicable to all variable rate local currency loans. So if you take a loan in foreign currency, KESONIA would not be applicable, because the imagination is definitely is. If you take a US dollar denominated facility, the benchmark for US dollar loans would really be the SOFR. The benchmark for GPP, the pound, would be the SONIA. So all those countries have determined their benchmarks for their currencies. So ideally, for local currency facilities, variable rate loan is where KESONIA plays in, but the customer is still availed the option of going straight into a fixed rate loan, in which case then the conversation is different as you approach your bank, because the determination of that fixed rate loan would be governed by what the bank would make available to you as you approach them. But then the governing structures for KESONIA would not apply.
Doc, final question on my part is this. A month ago, I had this conversation with the governor of the central bank, and I asked him this question, and I'd like to ask you the same one. We are told that banks will be publishing interest rates on a platform periodically. And I asked, is it fair? And this is where I was coming from. If you unbundle that formula, one of the components there, for example, is the cost of operations, essentially the efficiency. A bank could be rolling out, for example, new digital infrastructure which needed some heavy investment. The bank is not necessarily inefficient, but for that period, of course, the cost to income ratio will be suggesting that it is inefficient. Banks, depending on how they have postured in their risk appetite in this market, there are some which are retail facing, and of course, they gobble up significant risk. There are those who are corporate and investment banking focused, and if you look at their NPL, looks pretty good. Should those banks be compared on an apples for apples sort of platform? I don't think it is fair. I would like to get your thoughts, Doc.
Definitely, the bank now will have to make a decision on how best to spread that cost over the useful life of the investment that they have made, because what we are focused on here is really the cost related to lending, and how best to apportion that cost is really now a consideration that a bank has to make, because in as much as you have invested heavily in a particular, the reasons behind that investment is also to enhance efficiency on other spaces. So ideally, how it is going to be amortized through the useful life of that investment is very critical, and therefore the bank has to be very careful in how they apportion that particular cost to every loan that it has. So those are the elements that each bank weighs from time to time and is able to apportion. Is it a capital investment that a bank is making? Is it a cost? You have to make that apportionment at the end of the day. Is it really related to lending, or it can also be apportioned elsewhere so that your rates remain competitive at the end of the day? So that's an internal decision that a bank has to make, because while watching others, the need to remain competitive in pricing is very critical.
Thank you. Let's take this question before I invite you to give us your wrap-up thoughts, Doc. Is there a country that has implemented something similar to KESONIA? I know you've touched on SOFA and SONIA as well, but just clarify for us.
Yes, but of course, the critical examples or live examples is really on the SONIA and the SOFA for developed markets in UK and US respectively. But for African countries, we've heard of countries such as South Africa also in the discussions around developing a unified base rate, also benchmarked and aligned to global best practices. So it's good that we are getting into this space as Kenya, because the thought leadership in the region would start off from Kenya and the learning points. We are bold in moving in this direction, and therefore others would pick up the lessons and be able to implement the same. I can bet the countries in the region are following the discussions in Kenya and are keen to know. We've been approached by a number of them, and they are keen to know, and they want to know the learning points as we journey together. So there's expectation that what happens in Kenya is likely to happen, particularly in the EAC and other countries in the region. And that's why we are taking the bold step to learn as we go and make sure that we get it right from the beginning. And where there is need to make amends as we go, we do in good time so that the market transition is smooth. And we assure the economy that the credit supply would flow accordingly and not disrupt financing of economic activities. So that's the general expectation. But as far as where, I think we must be the first country to implement the type of framework that we are incorporating now, particularly in Africa. And therefore, we expect that others would learn from this. And then we have a rollout, because this is not something that is avoidable. It's global best practice. And therefore, whether we postpone it now, we will need to do it later. Therefore, we take the bold move.
Doc, our time is fast spent and I don't see any other questions coming online. So let me give you this opportunity to give us your parting shot.
So thank you. Thank you, Julian, for hosting this session. I think it is important because it's a journey that we are taking with a lot of caution. And therefore, as we move from the old to the new, we also must appreciate the collaboration that we are having with the central bank, because all this journey being taken together. And we've agreed that whenever there is implementation challenges, the central bank is readily available to listen to any challenges that the market may face and then take action accordingly. So as we transition, we want to pledge that definitely the refinements in the pricing is really in the interest of ensuring that credit in the market flows. And as it flows, the pricing conditions would reflect the risk profiles of customers, which is the standard best practice in risk-based pricing. So we anticipate that we will have a smooth transition, just to assure our customers that you would not face rates that is not commensurate with your risk score. We also want to encourage our customers to invest more in ensuring that their risk profile remains good and improving from time to time, because that is what will assure them. We now have an opportunity that with improved risk score, you're going to get better prices for your loans. And that, of course, would assure you that you could even take much bigger loans that can help you do more development. So that's the pledge that we give, but also the confidence that we have in the market to be able to deliver this is what we hold on to and ensure that all shall be well. We are investing quite a bit as the Bankers Association to ensure that all our members and customers for all the banks in Kenya will not face any losses as a result of this. There would be no disruptions to your banking business. There would be no, if anything, there would only be improvements going forward in terms of transparency in our pricing. So thank you very much. We must appreciate the opportunity to speak in this space, and we stand ready to come back again should there be another opportunity availed to us. We say a big thank you.
Many thanks to Dr. Tiriongo from the Kenya Bankers Association for joining us tonight for this conversation, which I must tell Mwango Capital has a lot to unpack in terms of the transition which is taking place from risk-based credit pricing model. We began with monetary policy and the evolution with the corridor for the interbank rate. We spoke about the contextual analysis of where we were last year and the cost of funds-based model and why it didn't work. And we have broken down essentially up till the point where we have discussed about the timelines deck first for all new variable loan rates. And by February 28, 2026, of course, for all existing loans, they should have been transitioned by that time. Thank you so much for joining us. Let's keep this conversation going. We look forward to the next, and many thanks to Mwango Capital for setting this up.